Well, markets remained attuned to geopolitical developments in the Middle East last week, with every man and his dog hedging their risk into the weekend, with both crude and gold popping sharply higher, but other asset classes seemingly taking rising tensions in their stride, with equities gaining ground for a second straight week and the dollar resuming its uptrend after a modest week of losses a week prior. It's a busy week ahead, with, of course, geopolitical tensions remaining on the radar, but a busy data docket awaits on both sides of the Atlantic. And of course, Q3 earnings season ramps up a gear as we move through the rest of the week as well. Plenty to discuss on the trade-off this week. So without further ado, let's get into the show. So plenty going on in markets at the moment on multiple fronts. Of course, geopolitics, the macro side of things getting interesting, as well as we've got a busy week of data ahead. And to help me navigate our way through it, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics joins us. Ryan, very good morning to you. How are you doing, mate? A good weekend.
Yeah, morning, mate. Hoping to navigate rather than crash our way through things this week. So, yeah. Looking forward to it.
Exactly. Well, we've already managed to crash our video software twice this morning, so hopefully we're not crashing anything else through the course of the show.
Definitely. Hopefully third time lucky, eh?
Indeed, yes. Well, plenty to discuss, so let's get right into the meat of it in Topical Thunder. So before we get into some of the geopolitical events and what we've got coming up this week, I just want to quickly talk about some of the data we had last week, namely the US CPI data. It was by far and away the highlight of the last 5 days in terms of macro releases. And I guess you could say it was something of a surprise. The year-on-year number at a headline level came in marginally hotter than expected at 3.7% compared to 3.6% prior, although it is worth noting that I think markets were pretty well positioned for that upside surprise after a hotter than expected PPI number on the Wednesday. Of course, the CPI came on the Thursday, so everyone was kind of expecting that to tick higher. The month-on-month headline was also a little bit firmer than expected at 0.4%, although that is a nice slowdown from the 0.6 that we saw in the month of August. I think what's probably more important for markets, though, and for policy, given that a lot of that headline increase has come as a result of energy prices, is that we continue to see disinflation in the core measures. So when you strip out energy, when you strip out food, core CPI came in as expected at 4.1%, and core CPI excluding services also continued to decline, which is exactly what the Fed are looking for at this stage of the cycle. So we didn't see too much of a hawkish repricing in the OIS curve. That the market's still seeing just 8 basis points worth of hikes priced by the end of this year. The first cut is still seen right at the end of the first half of next year. June 2024 is when markets price that, and there's, as near as makes no difference, 2 full rate cuts priced by September, which personally, I think that is still far too aggressive, even though the Fed are talking about the market having done a lot of their work for them in terms of the sell-off at the long end of the Treasury curve. Higher for longer is still the policy mantra. I don't see them loosening or easing policy anytime soon. And I think fundamentally the story is still one of US exceptionalism. We've got a busy docket out of the US this week: retail sales, industrial production, new home sales as well. And as long as that story remains intact, I think really higher for longer is the only game in town. Of course, we hear from Chair Powell on Thursday afternoon, I believe it is, and his remarks will be interesting. But I'm keen to get your view on this, Ryan, because I still think that buying the dollar on dips and being long the US economy against its peers, particularly on this side of the pond, is still the trade for me.
Yeah, I mean, it was a very strange set of data, PPI, CPI, because PPI, we saw the dollar rally just a bit, and then that got sold off. And then CPI, it came in, if you like, it came in unchanged. Headline year on year came in unchanged, was expected to drop a pip. So that pretty much halted the run of 2 higher CPI numbers that we'd seen in the previous months. Still looking very sticky, and that core number, as you say, that dropped back as expected. I saw a lot of commentators talking about this super duper core, whatever it was, that went higher, and that supposedly gave it a hawkish slant. But the reaction in markets, I mean, the dollar took off, and so did yields, and they jumped quite significantly. And it was a much stronger move on what was really lower CPI or unchanged CPI in most aspects, and it was a very strange reaction to me. But markets are going to do what markets are going to do. I think you're right about the dollar in terms of trading on the back of the US fundamentals, but we have got this blip with the Middle East stuff going on, which is just muddying the picture a bit, which we'll talk about in a bit. But apart from that, it's the data. It's still not soft enough. That headline has still not gone down. If it goes down next month, fair enough. We've had a little bit of a blip, and the Fed can carry on their way. But if that ticks up again, and if the core starts to maybe find a bit of a base and stops falling, and maybe even ticks higher, because it does tend to lag the headline number a bit, then that's going to put some awful pressure on the Fed, because then they've seen inflation come down and stop and then start to creep up again, and that's their big worry. If it does take off again, gets above 5%, say, we're going to be looking at hikes again, and the market's then going to be jumping on the bandwagon, and everyone's going to be screaming 6%, 6.5%, like Bullard was last week.
Yeah, absolutely. Oh, and Kashkari, he's the other one who's always out with all this nonsense. It's interesting you mentioned, super trimmed, mean, median core, or whatever people are quoting these days. I mean, it does sound a smack of desperation, really. If I take out the data or anything where prices are increasing, then there's no inflation. Well, yeah, but people have still got to buy food and buy, fuel and whatever, services and all the rest of it. So, I'm loath to give that too much attention in terms of a metric, to be honest, because, we're still dealing with, headline inflation and core inflation around the 4% mark. It's still double the Fed's target. And in that environment, certainly no sane policymaker is going to be throwing the prospect of cuts on the table anytime soon.
Yeah, I mean, I watched the metrics for Fed expectations, and the rate probabilities jumped from about 30-35% up to 50% after that CPI data, but came back down again. I think as far as the Fed goes, November is off the table. They're likely to keep a pause going on there, but I think it's December that the market's really circling on the calendar as the potential for that last hike that's sitting in the back pocket. So we'll have to see whether the data confirms that or doesn't.
Absolutely. And I guess the big sort of black swan event, if you like, or the big unknown in terms of policy making is how the situation in the Middle East may evolve and how that may impact the policy outlook. And I know you want to discuss that in a bit more detail, mate.
Yeah, definitely. And, we saw that in the latter part of the week, these Middle East tensions feeding into markets, particularly on Friday. And sometimes it is hard to trade through the strife such as this, where markets are moving because of something bad happening in the world. But trade they do, and we have to understand how that affects us. And on Friday, we saw what looked to be risk off and a run to safe havens via the usual suspects. That's the dollar being bought, as well as treasuries, moves into yen, Swissy, and oil and gold went up too. Now, I say it looked like a run to safety, but now I wonder if it was more just an exit of risk rather than a shift into those safe haven assets. For example, we know bonds have been selling off quite significantly, so there may have been some bond short-term shorts building up there, and they just decided to lighten the load into a risk weekend. And we also know that oil had been coming off the highs up at the 94s, 95s. So perhaps, again, a mix of short-term shorts, getting out of the usual Middle East trouble means buy oil trade kicking in as well. Stocks as well, they were buoyed by the good bank earnings, shooting up in S&P's 4370s, I think it shot up to. Didn't last long, dissipated afterwards down to the 4330s pretty quickly. The only real places where one could say there was a real flight to safety was the dollar and gold, and particularly for USD. It's been bid as yields have risen, and it's gone bid while they fell on Friday as well. Gold too went up. That's against its usual dollar correlation there as well. So how do we trade all that? We have to know what the market is thinking. And if this was just a weekend thing, we will see these moves maybe reversing, and some of them, as we sit here today, are reversing this morning. However, I think we're likely to see this nervousness persist until such time as there's either a full resolution or the market deems it, less important or unimportant, and there's been no spillovers. How long that lasts is anyone's guess. It could be a day, it could be a week. What we have to know is what we are trading right now, what the market is trading right now, and when markets shift back to trading what it was trading before, i.e. the fundamentals.
Yeah, absolutely. I mean, I'm firmly in the camp. I think that a lot of the moves we saw on Friday were folk firstly trimming their exposure to risk, and secondly hedging their positions as well. I mean, you've got to think actually the situation in the Middle East is incredibly fluid and uncertain, as we know. The weekend has been obviously violence has sadly continued, but we've also seen a lot of diplomatic efforts. The US Secretary of State is in the region holding meetings with a lot of key players there. There's reports being run by Bloomberg this morning, Monday, that President Biden may be considering a visit to the Middle East. So clearly the situation evolves quickly. And I think the way to really think about it is as a trader, do you want to wake up on a Monday morning with the market potentially in a very, very different position to where it was when you closed on Friday, and you could potentially be significantly underwater on the positions that you did have on? So I think the fact that equities were sold into the weekend, gold rallied, oil rallied, it is purely market participants saying, I just want to protect any potential weekend headline risk and the impact that may have on asset prices. And I think you're right. I think it does speak to how uncertain the situation is. I think we may see these sort of moves persist for probably a couple of weeks more until there is a little bit more confidence that there won't be any regional escalation or spillover effects of the conflict. But I'd certainly, can't imagine anyone wanting to take a significant amount of risk into weekend market closures at this moment in time, purely given how uncertain things are. So that sort of classic haven playbook, that dash for shelter and safety, is probably going to become a little bit of a trend on Fridays, you'd expect. But of course, if it does, then we may see the market starting to sort of front run itself on that one.
Yeah, exactly. And it is tough to trade because, all the time we're trading basically the fundamentals, what the central bank's going to do, the data, whatever. But then we get these events, these short-term volatility events that inject themselves into the markets, and it changes the dynamics of markets, like we've seen with the dollar correlation to yields and then gold with the dollar. And, there's two ways. A, you want to protect yourself first and foremost. If you had a strategy, if you had a play that needed certain fundamentals to fall in place, that might have changed in the short term. Conversely, if you've benefited from some of these moves, if you were long dollar and you weren't expecting this sort of move, then you've got to realise that might be a bit of a gift horse. The market's giving you a little bit of a bonus here to your trades. That's when you need to take some money off, because you know that if we get over this situation, we're going to revert back to where we were sometime before. So there's lots of ways you've got to look around it, but you've just got to know this is a little event that's different to what we're trading 2 weeks ago, and you've got to know to adjust your trading accordingly.
Absolutely. And I think the last thing that I would mention on that in terms of, adjusting your trading is that there are going to be headline driven moves that you're going to miss. You are not, it is physically impossible to spend 24 hours a day, 5 days a week at your desk, watching the screens, chasing every move. So if there is a rallying crude, for example, on a headline and you're making yourself a bite to eat for lunch, don't come back and try and chase that move. More opportunities will present themselves as time progresses and as things evolve. So, protecting your account, conservation of capital has obviously got to be the number one priority. And don't go chasing things that aren't there, as that is when you really do open yourselves up to the risk of ruin from a trading point of view.
Yeah, I'm sure there's a song in there, isn't there? Don't go chasing waterfalls or something. That's one
there
for
is,
no doubt.
It's 8:25 in the morning, and believe you me, no one wants to hear me sing at that time of day, or any time of day.
I was going to say, yeah. Let's move swiftly on, because I know you want to talk about some data as well.
Well, yeah, before this turns into a karaoke session, let's dig into what's happening here in the UK this week. It's a very, very busy week of economic data here in the UK this week. So, I've picked a great week to fly out of the country. In any case, we kick off with the latest jobs data on Tuesday morning, tomorrow morning. In fact, I think the data will probably be out by the time that you watch this show. It's an interesting one, actually. The ONS seem to have had a little bit of a shambles, a little bit of a hiccup with this data, because we're only getting the earnings data this week. The employment, unemployment, participation stats, they've all been delayed until the 24th of October. I'm not entirely sure why. Normally the ONS are giving us data early and leaking it rather than giving it to us too late. But there we go. Regular pay is set to rise by around 8.3% on an annual basis in the 3 months to August. And I think this is now starting to become a little bit concerning, because if that print is in line with those expectations, that would be 3 straight months of regular pay growth above an annual pace of 8%. And the last couple of months, it's been explained with, one-off bonuses for the NHS and for civil servants and all the rest of it. But, that's then a quarter of data where you've had wage growth in excess of 8%. And it's starting to get to the point that actually these one-off factors can't explain away all of that. So I think that may concern policymakers a little bit over at the Bank of England. We then move through the rest of the week. Wednesday, we get the latest inflation data, of course, watching that very, very closely. We're expecting disinflation to continue, although there is still an upward impulse coming through from energy, which poses an upside risk to the headline number. Headline CPI expected 6.6%. That will be down just a tenth of a percent from the prior month, from August. Core expected at 6, down from 6.2% previously. So that would be a little bit of good news for the BOE if that disinflation were to continue, although good news is relative, because headline CPI would still be 3.5 times above the MPC's target. Thursday is mercifully a quieter day, and then Friday, we get the latest retail sales numbers. Retail sales set to have fallen by around 0.3% in the month of September, coming off a couple of pretty solid months over the summer. August, it was very, very impressive indeed. And we also get the latest public borrowing data on Friday as well, which is not something I'd usually mention, but given how significantly we've seen bonds and fixed income sell off across developed markets, I think there probably will be an increased focus on government borrowing and the deficit, particularly at the long end of the gilt curve, where you've also got to bear in mind, of course, the BOE are selling their holdings at a slightly more aggressive pace. But I think amidst all of this, the risks are, for me at least, and I'm going to talk more about the pound a little bit later on, the risks for the pound are probably skewed asymmetrically to the downside here. I think it's a very, very high bar for the BOE to tighten further, to raise bank rate again. I think we had a few speeches last week that were pretty cautious in nature. I think everything points to the old lady being done in terms of rate hikes. So actually, I think the risks to the pound are for a much bigger move to the downside if we do get cooler inflation, if we do see further signs of weakness in consumer spending and in the labour market, then I think you're going to see the market rush to pricing cuts from the BOE a lot sooner than it currently does, because at the moment the OIS curve doesn't really price anything in terms of loosening through to next September. So certainly I think it's a big week here in the UK, and potentially it could be a little bit of a bumpy week for the quid.
Yeah, very much so. And I think you're right to highlight those wage numbers, because one-off factors should drop out pretty quickly, and the fact they haven't thus far suggests that maybe there is a bit of froth underneath, that maybe the BOE are looking at these one-off factors, as you said, the NHS pay rise and like, and thinking that's it. But we know that there's price pressures, wage pressures going on everywhere. There's all other areas, people having strikes, trains, for example, and other unions. So we're not out of the woods on that yet. So if we do get another hot reading, I think if it stays above that 8%, that's going to put a bit of pressure on expectations for them to stay on pause. Generally, retail sales on Friday, I don't know, it's typical. This is for September. As soon as the kids went back, we had an awful summer. As soon as the kids went back to school, the sun came out. And so I've got a little inkling that maybe they won't be as bad as expected, maybe even a positive number. I'm not expecting another 0.6, but maybe a plus 0.2 or something like that.
Oh, pop the champagne if we get that.
What 0.2% retail sales? It's not exactly everyone's been out opening their wallets, but positive numbers are positive numbers. But yeah, as far as the Bank of England goes, we'd still have, we had Mann out pretty much saying that another hike is on the table. Then you get Dingler saying we need to be on pause, and the next move is likely to be cuts, that sort of thing. So I think that the trade is still there. I've always said the Bank of England are most at risk for having to take rates that bit high if the inflation pressures remain. They've got another hike in the back pocket, and they might be more inclined to use it more so than the Fed. If this data is strong, whether that's the next meeting or the latter part of the year, I don't know. But I also agree with you that these rate hikes are going to start biting much quicker probably than anywhere else. And I think the Bank of England is going to be a front runner in the cut race.
Absolutely. I'd certainly agree with that. Someone who I don't think is going to be a front runner in the race to cut is the Bank of Canada.
No, definitely not. And it's interesting because Canada and the BOC, they lead the next round of central banks. And this week is going to be key for them because there's plenty of data to test their pause stance. Data's been pretty solid from Canada of late. The jobs market has been solid. It picked up in the last few readings. Inflation also has risen for the last 2 months, and core actually ticked up last month as well. This week, again, there's some top-tier data for the BOC to chew over. Their meeting's on the 26th of October, say the first meeting that kicks off all the rest of the central banks. So today, as we film this show later on, we get the BOC Business Outlook Survey and manufacturing sales. So we get a little look inside the factory gates. Tuesday, it's housing starts and the important inflation data. Inflation is expected to come in unchanged at 4%. So we need to see if that moves up again or does it hold. Thursday, it's PPI, and then Friday, it's retail sales. So again, a good look inside a broad swathe of the economy there. Now, various Bank of Canada members have been turning more hawkish of late, as we've been highlighting on this show. And on Friday, Governor Macklem pretty much opened the door to another hike by saying that the Governing Council is to focus on whether to stick to 5% rate or if more action is needed to restore price stability at the next meeting. So the door is firmly open for a hike there. And, how do we... It looks like they may be one step away from another hike, and the data this week will go a long way to confirm whether it comes sooner or later, or even not at all. So it's going to be a hot one for the loonie this week, I think.
Yes, absolutely. I think it is it's going to be a very interesting week in the UK and in Canada in terms of data. I think some of the US data perhaps matters a little bit less, although obviously it will be key for this kind of US outperformance narrative that the market is continuing to trade on. I do just wonder, I still think that the question for central banks is one of duration rather than rate level. I still think that, we would need very, very hot data indeed out of Canada this month to get another hike from the BOC. So I do just wonder whether, and I know, Macklem opened the door to it last week, et cetera, but I do just wonder to what degree we might end up with this being a kind of buy the rumour, sell the facts trade in terms of the loonie. If we do get stronger than expected data, we would obviously expect to see a hawkish repricing in rates. The Canadian dollar should strengthen off the back of that. But if the BOC then come in and say, we're done, we're not going to raise rates again, it is all a focus on duration, or give that optionality but leave policy unchanged, then I think the wind could come out of the sails of the Canadian dollar pretty quickly. So certainly one to be very, very careful of if you are trading the expectations of another hike. I think it's far from a given that the tightening cycles will resume. Yeah,
that comment from Macklem, it just sticks in my mind because it is a very strong comment on that they're maybe looking to hike. And I think, it may... One more hike isn't going to make much of a difference to anything, but I think what's going to be more important is the message that the market's going to take from that. They're going to take, here's a central bank, they went on pause, they were happy to stay at their level because they thought they had everything contained, and now they haven't got it contained because they're now forced to hike again. And and the market's going to extrapolate that across the Fed, across the ECB, across the Bank of England, and it's going to then bring potentially another wave of hawkish repricing for central banks if the market thinks that they're all in the same boat. The RBA was forced to do the same. They paused, they hiked, they paused, they hiked. and they weren't in control of anything. And if that message spreads again, then we are going to see a bit of a change in the market's mood.
Absolutely. I mean, the RBA seem to be doing quite a good job of making the BOE look competent at this point, which is, a challenge. And I'd also say, there is no chance the ECB hike again. Absolutely no chance.
Oh, that's a call and a half. Oh, we'll have to.
I don't think I'm really sticking my neck out with that one, to be quite honest.
Well, we shall see, won't we?
We shall, but we're certainly not having another one.
Maybe another little bet coming on.
Absolutely not. Right, let's get into some charts in That's the Setup. You can tell it's early and I haven't had enough coffee, can't you? Calling the Bank of Canada the Bank of England, almost forgetting the name of the segments on my own show. It's all falling apart over here. Right, let's get on to slightly more familiar ground. I want to talk about gold, first of all. As we discussed earlier, a big old rebound in gold last week. Most of that, of course, coming on Friday as everyone decided to hedge their risk into the weekend and seek a little bit of shelter against any potential conflict escalation and geopolitical headlines. We have seen a little bit of wind come out of the sales of the yellow metal in very early trade on Monday morning, but we are still trading at pretty promising levels. And I think the bulls have firmly got the upper hand in the market now. If you look at spot gold, which is what we're looking at on the chart here, we closed back above the 200-day moving average on Friday. I guess the only thing that I'm slightly cautious about is just how rapid the rally has been. We've come, $100 in the space of 5 days. And the other thing that is, of course, worth bearing in mind is what the rally is built on. It is all built on this idea of seeking shelter and a haven from what's going on geopolitically. So if we were to see things simmer down a little bit there, or if we were to see the market become a little bit more reassured that there's less chance of a conflict escalation, then we may see gold pull back a little bit. But from a purely technical level, although personally I must say I've never really understood the appeal of gold as a haven when you can just take treasuries at 5% and park your cash there, we can only trade what's in front of us. And the technicals are saying that the bulls have wrestled back control of the market and they'll be looking to the upside at that 1950 level as the next target. And I think from a balance of risks point of view, it's not something that I'd be looking to short at the moment. If anything, I'd just be looking to stay out and wait and see how the dust settles, rather than looking to fade into any strength.
Yeah, this is one, and again, it's another warning for traders that you've got to be careful when you get these types of events that your text, your coloured lines, whatever, they're not going to work.
Yes.
If the market needs to move and put its money somewhere, it doesn't trade funny coloured lines. So this one, we've been talking about it over the last few weeks. The 1885, 1900 level was very important in terms of potential resistance in this move. It went through that. It's gone through 1900. It shot all the way up. It's had a bit of a pullback, but just like you said, it's quite dangerous, to try and lean your techs on this. What you tend to have to do is, okay, we've had a big move now. It's not going to go up forever. So that's the point where you start to look at your techs and think, well, if it's going to run into trouble somewhere, where's it likely to run into trouble? It's pretty much run into trouble, 1930s, which was a prior, support and resistance area. And that's become the stretch point for it. So as much as you, in the short term, you ignore the techs, after it's made a move, look at where prices may then hit some levels where the market says, okay, enough's enough, you've gone far enough. That's the sort of levels you need to lean on. Same thing on the way down. If this event dissipates, probably the 1900, the 1885 level isn't going to stand up too much on the way back down. What you'll need to look at is then perhaps the 1810 level, where the market before this news decided that's where it was going to park its bids at. So be careful in the middle, trying to guess where to go. Let the price action tell you. If we continue this risk off move, but we can't get above that 1930s, 1940s, and it becomes solid, then you got some conviction to trade against that level.
Exactly that. Very well said. Right. Well, your worrying obsession with Canada is going to continue here, mate, I think.
Well, I might as well keep it topical, try to lead it from one end to the other. That's supposedly how the professionals do it. But,
I wouldn't know.
Amateurs, us amateurs trying to emulate it. So anyway, but yeah, we're talking about, we got this data for the Bank of Canada to look into this week. So we might as well look at what dollar CAD's going to do. This was actually my play of the day last week to get into shorts on a rally over the US data. That didn't go too well. It did because the 137 level held, but I've messed around over the CPI. I saw a rally to 136.50 on the PPI, or I wanted a rally to 136.50 on the PPI. I didn't quite get that far. I didn't get the price move there, but still the market showed me that a bearish US dollar was right, or the bias I've got right now is right. So I thought I'd look to do the same trade on the CPI data. This time I hit a move to 136.50 and got taken out not too long after that as the dollar kept going. And then with those geopolitical risks kicking in and the broad US dollar strength, I left it alone. And thus, obviously, it went to 137, tapped the number by about 2 pips that I was aiming for in my original play of the day. And then Macklin came in as well and gave it the shove lower with his comments on a possible hike. So why is this story important? Well, it's important to me because outside of messing up my trade plan, the price action confirmed my thoughts on both the US dollar and the BOC. So as traders, that's confirmation that our thoughts are on the right track, and that can obviously help us with the next trades. So for dollar CAD now, I'm still bearish on the back of a hawkish Bank of Canada. I've had further evidence now that I'm right via those Macklin comments, but now I have a chance to hopefully have a better plan than the one last week. So while the 137 level held last week, this week might be different. So I'll be using the Canadian data as my guide. If it's strong, but the geopolitical risks still favour the US dollar, I'll be more cautious about entering a trade because the dollar CAD is likely to move higher. Maybe I'll keep my short idea closer to the Bank of Canada because the risk side will outweigh the BOC side throughout this data. But if the data is weak, then my plan will look less certain because we won't get the move more hawkish on the Bank of Canada. So I'll probably sit on my hands. But on the tech front, it's playing nicely, again, with the trend line above. That comes in around that 137 area. Above there, we still have a strong level into 138. To the downside, support around about 135, 70, 80, a bit of an intermediate level. Stronger is down at that 135 number. So I'm still favouring shorts. I'm going to let the market do its thing and see what it wants to give me. But there's plenty of room to roam within the range and trade the levels, irrespective of your bias.
Absolutely, incredibly comprehensive there, mate. There's not really too much I can add to that, I don't think. The only other thing I guess I would say is, of course, you need to consider with the Canadian dollar and also with things like the NOK as well, just the impact of crude. We do see a tendency within the market when there's geopolitical risks, particularly in the Middle East. The market does love to overprice the chances of supply disruption, which you might argue we've probably seen this time around, particularly with Israel and the Levant region not being a massive crude producer. So we could see some of that risk premium priced out of crude, which would obviously be a headwind for the Canadian dollar. But it's not a one-dimensional trade. There's a lot of moving parts, and probably even more than normal right now, given everything that's going on. So I think again the message is, risk management absolutely key, and wait for the market to come to the levels that you've marked out. Don't go chasing things.
Yeah, very much so. And again, it's another one where, the Bank of Canada is a longer term trade, or it's what we trade normally. If this risk event is trading something other than the Bank of Canada, then that's when the opportunity to trade the BOC, even just for that day, may become a good trade. If dollar CAD's trading at 138, ignoring the Bank of Canada stuff, ignoring the strong Canadian data, if that's what it is this week, then you've potentially got a little scalp attempt over that Bank of Canada.
Very much so. Right. I want to talk about the dollar. I'm moaning about you repeating things earlier. I'm now going to do that myself. So feel free to come back at me then, mate.
Oh, don't worry, I will. I will. Don't you worry about that.
I'm sure you will. I've got no doubt. For me, the dollar is still the best of a pretty grim and dismal bunch in terms of G10FX, that kind of cleanest dirty shirt theory coming through once again. And we still see both sides of the dollar smile working in favor. You've got the US outperformance or exceptionalism, of course, and also some haven demand coming in. And I think that was very, very clear last week when the dollar was able to rally and resume its uptrend, despite the fact that we saw quite a chunky rally at the long end of the Treasury curve, and the curve itself actually bull flattening in a pretty chunky way. So the fact the dollar was able to rally in that environment speaks to how significant the haven demand for the greenback was coming in last week, and it allowed the dollar index to recover quite nicely from the 105.50 level that I flagged last week or the week prior as an area where I'd be looking to buy into weakness. That what proved to be quite prudent, and we then traded nicely back above the 106 handle and back into the uptrend that we've been in pretty much since the middle of July. And I think really the outlook for the dollar remains what it was when we were discussing this a couple of weeks ago. Obviously, you've got a lot of factors on the bullish side. For me, there's not a lot of reason why I'd be looking to get short of dollars at the moment, perhaps against the Swissy or the yen if you were looking for an alternative safe haven. But elsewhere in G10, I think that the dollar really remains the only story for me. And I think we're just looking for the dollar index to get above the prior high, which comes in around 107.20. And even when we do, that could be the next catalyst to really start the next leg higher.
Yeah, and we know, the Dixie is a lot made up of or heavily weighted to euro dollar.
Of course.
And that's I'm going to speak about that a bit later. But that coming back down to close to the prior lows is helping that. But the dollar index hasn't had its own way. I mean, dollar yen, we saw a bit of a bid going into yen pairs. So dollar yen wasn't rising as much as other dollar pairs. So that's probably why we're not seeing the Dixie closer to those highs that we saw previously. But, the risk washing machine is on, and until the cycle's finished and we see what comes out the drum, we don't know which way this one's really going to go, whether it's going to continue going higher or if we're going to see a little bit of a reversal again.
Who writes those lines for you?
Well, someone who doesn't write your lines, I'll give you that.
Well, thank goodness they don't, is all I can say.
I'll give you a number if you want.
I think I'll pass on that very kind offer.
Okay.
We'll talk about treasuries, shall we?
Yeah, let's move on to treasuries then and forget the washing machines. I'll talk about tumble dryers for this one.
Oh, please do.
Now, the US 10-year yields, it should be a chart that everyone should have open on their screens. One has to keep in mind what situation assets were trading before the geopolitics kicked in and started moving markets. So if we purely take away the geopolitical aspect, we were trading the data and what it meant for central banks. And yields have told us a very clear story over the last couple of weeks. Firstly, we've likely finished pricing the higher for longer trade, hence why we put in that pretty significant double top up near the 490s. Secondly, where yields have struggled when bonds have been bought is down into the 450s. So that's the level of support, if you like, for yields down around that 450s area. And thirdly, that the 470 level and the area around there is important once again. I mean, it's quite clear on the chart. I've marked the double top up there. We've had the 470 level in the middle. The 450 was a prior level as well. So that 470 we hit after the CPI, but the fact we couldn't hold above it is pretty telling. And now, despite my bearish slant, bearish bias on the dollar, I'm not expecting any sort of collapse, and yields may define that also. So I'm expecting a range to develop here, pretty much between maybe 440, 450, and up towards the prior highs. That's if that 470 area doesn't solidify further. Now, to break those prior highs, as Michael mentioned earlier, we need a much more hawkish Fed, which will only come if the data remains really strong, if inflation starts rising again, including that core, and something like those jobs numbers, they continue above the 250 plus range. Then if we see the tensions easing in the Middle East, there's likely to be a knee-jerk reaction in yields, but then we need to see where they settle as they switch back to trading those fundamentals and the Fed. So for now, I'm seeing a possibility before this geopolitical stuff of a range developing. I don't think we're going to be going down to 4.3s, 4.2s, purely because of the stance of the central bank and the higher for longer. But it's going to take something to really bust those highs. That's all important for trading the dollar, because the dollar is going to follow yields an awful lot, particularly pairs like dollar yen. So if we're going to see the Dixie breaking higher, that's one of your triggers, is going to be seeing yields moving back up towards those highs and maybe even breaking those highs. If it doesn't, then I'm going to stay a bit more bearish, at least in the short term, on the dollar.
No, absolutely. I mean, I can't remember who it was. I've spent your whole little segment there trying to think about this. It was either Buffett or Dalio or someone like that who said, if I could only look at one thing when I wake up in the morning, I'd look at where the 10-year yield is, and it would tell me everything I need to know. So someone can put a comment in about who that was. And I couldn't agree more. And I think that's even more so the case, given the amount of risk in the market at the moment. It is the barometer, I would argue, for how the market currently perceives, Fed policy, of course, the macroeconomic outlook, and of course how the market is trading the geopolitical situation. So, as you rightly said, Ryan, if you're not looking at the 10-year Treasury yield, if you don't have that somewhere on your screens or on your phone or wherever, what the hell are you doing ultimately? Because I think that is probably the key thing to be watching in the markets at the moment, because that is going to give you a steer on where the dollar's going. It's going to give you a steer on where equities are going, where gold is going to be going, where crude is going to a certain extent as well. And I think it's absolutely pivotal that traders, even if you don't trade bonds, even if you're not fully sort of compos mentis with how the Treasury market works, just having that 10-year Treasury yield, the nominal yield, somewhere on your screens will give you a lot of information that you can extract from that. And I think you're right. I think we are seeing sort of haven demand take over at the moment as the main driver of things, given that rally last week. The market seems pretty happy with where it is in terms of Fed policy. But we've got a fair few speakers this week. I think Williams is speaking a couple of times, of course, New York Fed President, Vice Chair of the FOMC. We hear from Powell on Thursday evening as well. So, if the situation in the Middle East remains relatively as it is at the moment, and the market doesn't seem too concerned about potential escalation, then those comments that we get a little bit later on this week could be very, very important for driving bonds, but also driving the buck as well.
Yeah, very much so. I think Powell's going to be, maybe important. He's speaking at the Economics Club of New York. Whether he touches on monetary policy is another thing. But if he has a message to put across to the markets, be it for the upcoming FOMC, that's what it's going to be. And like we say, yields are going to move. And you're quite right. It doesn't matter if you're not a bond trader. This is just one of those weather vanes you look at to see, where is the market sentiment drifting, and you use that for its correlation to the dollar.
Exactly that. Right. Let's get on to some actionable ideas in our plays of the day. So, relatively short and sweet here from me. We discussed the UK in quite some length earlier on. So, looking at cable here, and as I'm sure most will be familiar with at the moment, I am still bearish on the pound. I think cable remains pretty unattractive, to be honest with you, both in terms of the policy outlook and, of course, as we were mentioning earlier, in terms of the risks coming out of the data this week. It's a very, very high bar in my mind for the data to push the market towards pricing another hike from the BOE, and instead I think what the data is poses a greater risk of is the market actually pricing out some of the modest tightening that is still in the OIS curve, and even bringing forward the pricing of the first cut from the Bank of England. If you look at things from a technical angle, cable failed twice last week to break north of the 123 handle. We've come back a little bit since. Of course, a lot of this was driven by the dollar side of the equation, but I'm happy to remain short cable table here, and I'm still looking for a return back to the prior lows, which were around 120.75, and then maybe even a test of that 120 handle if we get lucky. And I've managed to do that in 60 seconds, which I think is a first. Ryan, let's see if you can do the same.
Well, I hope I've got the same amount of time. You've now eaten into it with that little claim. So, yeah, I'll make this one a quick one then. Euro dollar, it's crunch time again. Once again, we've been down to the big figure 105, that big level. And we really are facing a bit of a crunch moment. For once, I don't need to write chapter and verse about this subject. There's two.
Hallelujah.
Yeah, see, now you're taking my time again. Look at that. I'll have to rush even more. There's two levels to watch here. First is that 105. The second is that 104.50, that prior low that we hit. Hold some decent sized barriers down there, hence a big reason why it bounced from there. I've already in a trade here. I was long, started building along from 106 on the CPI data. Bit of a scout trade on that one. Not the right trade as we saw. The dollar kept going, but I've added down in small pieces down to that 105 level. I'm keeping my risk pretty low on the whole trade. If it breaks again, there's a high chance it's going to stay broken unless it's purely a risk move on this geopolitical stuff. If it holds, I'll stay along, but if it breaks, I'll get out and maybe look to initiate shorts if that 105 level becomes resistance. The barrier may help to give that some confirmation. If we move down to it, then bounce back to 105, and 105 holds at that point, then a third test of that barrier from that scenario would likely mean we're going to knock it out, and then we go lower. So I'm long for the moment, but if we do break 105 and confirm, I'm looking to flip it short.
Good stuff, as always. Well, that does bring us to the end of another show. I think just to reiterate that key message, there is a hell of a lot of uncertainty going on in the markets at the moment. Hopefully we've managed to navigate through some of it, but protecting your account, protecting your capital remains absolutely key in markets like this. Certainly don't go chasing trades and positions that potentially don't exist, as you will more than likely end up getting your fingers burnt. And that is often the way when dealing with these geopolitical events. That is why you see markets rush into havens, and that is why traders should be very, very careful indeed around what's going on. In any case, thank you very much as always to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me and helping me to make sense of everything that is going on. Thank you also to our producer Kyriakos for bringing this together as brilliantly as he always does, and being incredibly patient, spending 15 minutes fixing something that I had broken earlier on before we started recording. So thank you very much indeed for that, mate. If you've enjoyed the video, thank you very much for watching. Drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we'll be back with another show this time next week. Thanks as always, and goodbye for now.